Well, every budget has one big measure, and the continuation of fiscal drag, the freezing of thresholds, was a big measure in this budget. Ultimately, it's going to collect 12 billion in a single year at the tail end of this policy. So it's a big policy which has helped the Chancellor balance her books. So what we have is a further freeze on the tax thresholds up to April 2031. And there's also a freeze on the inheritance tax nil rate band at its current level of 325,000 up to April 2031 too. Now that's been frozen since April 2009, so this freeze has been going on for a long time. Along with the freeze in the thresholds, which is collecting the Chancellor a good deal of money, she's also increased the income tax rates, but only on certain sources of income. So for dividends, the income tax rates are going up by 2% for basic rate and higher rate taxpayers. So that brings the rates to 10.75% and 35.75% respectively. Curiously, there's no increase in tax rates for additional rate payers. So for those getting dividends where their income's above £125,140, there's no increase at that level. I think that's probably to appease entrepreneurs who use the dividends as part of their remuneration. So this is really there to collect tax from people who've got investments, passive investments and savings. That applies from April 2026 onwards. So you've got an opportunity, if you wish to take dividends and you're a basic or higher rate taxpayer, you've got between now and April 2026 to take dividends at the current rates, and the OBR expect about £300 million of dividends to be accelerated between now and April 2026. We're also going to see an increase of 2% of the basic, higher and additional rate, in this case, for savings and property income. So the rates will become 22, 42 and 47% on savings and property income. That's for a buy-to-let landlord, it's already a pretty punitive tax regime. If you've got mortgage debt against a residential property, the effective rate of tax can actually creep up to 70, 80 or even in some cases 90%. So adding an additional 2% in just makes certain residential property portfolios with mortgage debt attached to it very unattractive to hold personally. The savings allowance, the personal savings allowance, the dividend allowance, all of these remain unchanged. So at the lower end, if you've only got a small amount of dividends or savings, you may not feel it. So this is really to appease perhaps retired individuals with small amounts of investments. These tax increases make things like ISAs even more attractive, although there is a change in ISAs. So only £12,000 can be held in a cash ISA, with £8,000 needing to go into stocks and shares from April 2027. But wider ownership structures should be considered. Things like family investment companies to hold investments where dividends can be accrued generally tax-free, and property holding companies to maximise interest relief on mortgages and escape this extra 2% tax. So an opportunity to review ownership structures, otherwise a general upshift in income tax rates, but not for ordinary working people. So the Chancellor just about managed to stay manifesto compliant. In the run-up to the budget, there was lots of talk about wealth taxes. They are very difficult to implement. So the government have taken the easy option of just, let's call it a mansion tax, but its full name is the High Value Council Tax Surcharge. It applies from April 2028, so we've got a bit of a lead time before it comes in, and it applies to properties worth more than £2 million. So we have 4 brackets: properties between 2 and 2.5 million, properties between 2.5 and 3.5, properties between 3.5 and 5, and properties above 5 million. At the lower end, the annual surcharge is £2,500. At the higher end, for properties above 5 million, it's £7,500 a year. There will be some exemptions and reliefs from this for people who live in job-related accommodation, but they're going to be few and far between. There will be an extension of this regime to properties owned through structures like companies and trusts. So it's going to be quite difficult to avoid this if you live in a high-value property. In the short term, in the years leading up to this tax being introduced, the government are expecting this to actually cost the Treasury £335 million. That's because they expect this regime to bring down property prices. So if you've got a property worth 2.1 million, it's now really worth 2 million because no one's going to pay the excess, knowing that that's going to walk them into this new tax. It will mean that lower property prices means less stamp duty land tax collected, less capital gains tax collected, but in the fullness of time, the revenue expect this to be positive for them, even though they anticipate a lot of appeals around property valuations. It's going to be a really difficult tax to collect because there will be a lot of arguments around valuations. Whether this is a tax that's here for the long term remains to be seen. So from April 2029, the ability to make salary sacrifice contributions into a pension are being limited to £2,000. Any salary sacrifice contributions into a pension above that limit are going to suffer employees and employers' national insurance. It will make salary sacrifice schemes a lot less attractive for employers to implement because there isn't now any financial benefit in doing so if they were previously benefiting from the employer's NI saving. For somebody on a salary of say £100,000 and they've got a 5% employee pension contribution, they might be sacrificing that into their pensions. That's a £5,000 salary sacrifice. £3,000 is no longer going to benefit from the national insurance saving. For the employee, it's not a huge amount, so there'll be 2% national insurance, the top end of employees' NI, and that's at £60 additional employees' national insurance. The employer, 15% on the £3,000, is a £450 additional cost. Now, if the employer was putting that into the pension scheme for the employee, it's a reduction in what's ultimately going to fund the employee's retirement later. So there might be a knock-on effect of this policy in years to come when pension pots are smaller than they would otherwise be. If employers just stop implementing salary sacrifice schemes, what we're going to find is a number of employees in relief at source schemes are going to have to claim their tax relief on their tax returns. We know that a great number of employees don't do that with over £1 billion of unclaimed tax relief, so there could be a hidden windfall for the Treasury here just by salary sacrifice schemes becoming a lot less prevalent and a failure for employees to claim the relief they're due. So it is possibly a bigger windfall for the Treasury than is currently being estimated. Well, every budget, there's always a concern that EOTs are going to get some attention, possibly a restriction in tax relief, and we weren't expecting, it wasn't really talked about or trailed, but we got a bit of a surprise today that the tax relief available to individuals selling their companies to an employee ownership trust has now been reduced from 100% relief to 50% relief. What that means is that previously when a business was sold into an EOT, there was a little bit of a stamp duty charge, that was only 0.5%. The capital gains tax charge that's now going to be applied, and this applies to any sales from budget day from the 26th of November, so it's immediately effective. The capital gains tax payable is going to make EOTs significantly less attractive because that capital gains tax has to be funded in reasonably short order. Say, for example, a company's being sold for £20 million into an EOT. Previously, there'd have been no capital gains tax due. Now, assuming a very low base cost for the shares, which is often the case, there's going to be capital gains tax on £10 million, so 50% of the gain. That's a £2.4 million capital gains tax liability, and that would need to be funded on the normal self-assessment timetable. If there's not money in the company to allow that to be paid, an EOT just isn't going to be feasible. So this has vastly reduced the attractiveness of an EOT, which is a bit sad given that this was a regime which really helped improve employee engagement, and the government are concerned about productivity gaps in this country. This was one of the measures that was helping to improve that. So a real backward step. We'll see if this is reversed in the future.